Welcome to my mini lecture introducing managerial accounting. And in the next couple minutes we're going to cover the definition and theory behind managerial accounting, as well as cover some terms that I want you to memorize so we'll be able to speak management accounting language to each other as we study this semester. So let's first start with the definition of managerial accounting. And what I really want you to concentrate on here is this little term here, internal users. Managerial accounting is about internal users, providing information to management, the people who make the decisions on running the business. We don't necessarily have a lot of rules and regulations regarding managerial accounting. It's more defined by what the managers need to run the business, and they define, management decides what it needs to run the business. So let's take a look at the alphabet soup of accounting, and I've got up here a lot of acronyms. Some of them you're going to recognize, some of them you're not. The first two here, I've got the SEC, Securities and Exchange Commission, and the IRS. These are both outside groups that set rules on how companies need to do their accounting, how they need to account for their transactions, and how they need to report the information. The IRS wants to see information in a tax return every year. It wants information presented in a certain format. Same thing with the SEC. For a public company, they want an annual report in a certain format and then quarterly information, quarterly reports in a certain format. With managerial accounting, we don't have these outside groups giving us rules. The next screen you see here is a little snippet from a General Motors financial statement, and what I've done is I cut away a little piece of their income statement for the years ended December 31, 04, 05, and 06. According to generally accepted accounting principles, this is all General Motors has to disclose. Its revenue of $207 billion, and we've got cost of revenue, and then it's operating income or loss. So all the SEC requires is one line item for revenue. What is your total revenue? I want you to all consider for a moment, if you're the president of General Motors, is this enough information to run the company with? Obviously not. You might want to see, where did the revenue come from? Did it come from the U.S. or did it come from overseas? Did it come from automobile sales or did it come from government contracting? We may want to even have further information like what kind of profit did we have per product? Did we make more money on big cars or small cars? All of that I've just described is an example of management accounting and management information that management needs to run the business. So anything really outside the scope of what generally accepted accounting principles or the IRS or the SEC is going to require, something that management decides it needs in order to run the business, that's what we're going to throw into that management accounting bucket. Okay, next thing, let's talk about a couple of terms, and I'm going to ask you to memorize these terms, the main management functions inside a company. First term I want you to memorize is planning. And planning is about all of the thinking and strategy, the objectives. When we start an organization, whether it's a not-for-profit, a private company, or public company, we're starting it for a reason. What is it supposed to accomplish? Is it supposed to make money? Is it supposed to serve people? How many people do we want to serve? All that goes into the planning of an organization. And even though these terms are very, very logical, I still want you to memorize these three terms as the three main functions of management. So after we plan, we do the brain work and decide what we're going to do. The next item, the next management function is directing. What you can think of as making it happen, hiring people, supervising those people, telling them what to do, buying property, opening factories, opening retail locations. That's all about directing, the doing of business. And the last main management function is controlling. What you can think of as getting feedback to find out if our directing and our planning is correct. After we get feedback, we may change our plans, decide that, well, we don't want to be a nationwide company, we only want to be a regional organization or a citywide organization. Or perhaps we could get information from our controlling and feedback that says, well, we're not doing a good enough job in directing our employees, hiring the types of employees, so we're going to change the way we run the business a little bit. So I want you to memorize those three terms. The next terms I want you to memorize are regarding manufacturing costs. And we can think of either manufacturing costs, this could be in a production, or it could be in a service company, or it could be in a goods manufacturing company. But we have three definitions of costs, and I want you to memorize these. For every product that we produce, we're going to have these three components. Direct materials, this is the stuff in the product. Direct labor, these are people who are physically making the product. And manufacturing overhead, which are going to be the other costs related to manufacturing the product that you physically can't see within the product. So we think of manufacturing overhead, they have a little picture of a plant here. You can think of the lights in the plant. You can think of the physical cost of the plant. That's not inside the product, but we still need it to manufacture. So these three terms, direct materials, direct labor, and manufacturing, I want you to memorize those terms. We're going to use those throughout the course. Another way to think of cost is we want to break all of our costs into two different groups, into product costs and period costs. So product costs are everything that go inside the product, such as the direct materials, direct labor, and manufacturing that we just learned about. All of those are related to building a product or providing a service. When you're building a product, then those costs are going to be inventoriable. They'll be on the balance sheet until we physically sell them. Period costs are going to be expensed in the period that they're incurred. We're never going to inventory them. So selling and costs, administrative costs, the cost of the accountants, all that's going to be expensed every single period in the period in which it's incurred. So there's a couple more terms, and I want for you to study these on your own. I've got some terms on the screen here. A couple of them in red: value chain, just-in-time inventory, and theory of constraints. I would like for you to go to Wikipedia and look up those terms, and you don't have to memorize them, but I want you to be familiar with the terminology. I think the most important here is theory of constraints. That's a really, really interesting way of running a business, looking at where the bottlenecks are. And a good example of theory of constraints is, you think of all of the work that a big retailer like Walmart does to go and produce products or specify what kind of products it wants to ship them to a retail location. They've got hundreds of thousands or millions of square feet of retail space. But if you go there at 7 or 8 o'clock on a Saturday morning or 9 o'clock on a Saturday morning and there's only one checker who is taking money, Walmart is limited on how much they can physically sell. So they're constrained at the point of the checkers, the people who are checking out and taking money. So keep that in mind as you study the theory of constraints. So this is my introduction to managerial accounting, and I look forward to seeing you in class.